Whilst buying at the very bottom and selling at the very top sounds all well and good, the question is, how can you do that in real time? The answer is, you can't. When price is in the now, in real live time, there is absolutely no way, apart from speculation, that you could possibly say, this is going to be the very top or this is going to be the very bottom. Unless you're somehow able to see into the future, there is genuinely no way that right now you can say this is the very high or this is the very bottom. There's a few ways that you can figure out that price is overbought or oversold and that it might be the top or bottom, but still it is just down to speculation. There's no way to say this is definitely the top or this is definitely the bottom. So instead of trying to time the markets, smart investors use an approach called dollar cost averaging. And this is the most educated and most accurate way to time an investment into the markets when it's going up in the long run. Dollar cost averaging is where you invest a fixed amount into the markets every single month to basically catch a balanced price over time. Instead of picking one point and saying, I'm going to start here, when you're doing so, you're basically gambling that that's going to be a trough. You could do that and it'd be a peak. And your investment is just going to go down over time. And even if it goes down and then goes back up over time, you've still just broke even. Compared to if you spread the risk of that investment out over time, you're playing it smarter. And you're using a factor that we call time in versus timing, which is where the time in the markets is a better way to play it than timing the markets. A novice investor will say, I'm going to put £500 into the financial markets. They'll choose today or whenever they feel like it and put £500 in the markets, and they don't realize that they're gambling with that deposit by saying that this is a good time to invest. Instead, a smart investor will say something like, I'm going to put £250 a month into the markets, and then every single month, maybe the first day or the last day of each month, they'll deposit £250 into the markets along a set interval, no matter if the market's up, no matter if the market's down, and what they're doing is they're spreading their risk out over time. With no investment are they saying, this is a good time. They're being smart with their time and saying, I'm going to catch the balanced price of this over time. Let's say they do that for 12 months. And instead of just picking a point at the start and saying, I'm going to deposit this lump sum into this point and letting the markets play out, they deposit 12 times over the next year and they catch the average price or the balanced price as that graph is moving. By doing this, they counteract that element of timing. They could have deposited at the highest day that price was in the whole year and then price retrace and come back to that point. In doing so, they would have made nothing because price has just gone into drawdown and then returned back to the starting point. But by spreading it out over time, they're utilizing the element of time in the markets. And by catching that balanced price every month, they would have kept buying when price was in drawdown and coming back up. And in that same year, they would have been able to actually make money because they've spread out their deposit rather than gambling and ending up depositing at a peak. This way, you counteract the element of timing and use the power of time in. But anyway, enough of me just yapping. We've got the charts here in front of us, so let's go through some examples. Right now, I'm looking at the S&P 500 on a weekly time frame. If you remember back to the start of the series, the S&P 500 is the top 500 stocks in America, all bundled up into one index fund. So we can see that over time, price is rising, following the growth of American companies. There is some peaks, there is some troughs, there is some winning streaks, there's some losing streaks. That's just how the markets move, okay? So let's look at an example and we'll go to 2021, okay? So let's go to the start of 2021. If we go here, roughly the start of 2021, let me pop my line down and we'll go to the 4th of January 2021, okay? Let's get the grid on. So we'll just say that this is the start of 2021. It's the first week of 2021 right there, okay? Price was there, okay? Let's go through two scenarios, okay? Let's say that we deposited then and just held it all year versus we deposited every single month in 2021. Okay, so case scenario 1. So we start here, start of 2021, and we would have gone deposit, price gone up, price gone down, price gone up, price gone down, price gone up, price gone down, up, down, up, down, up, down, up, down, up, and then here, round about there, is the end of the year. So you would have made about 24.3% using a buy and hold tactic of the S&P 500. However, I'm telling you, you got lucky, okay? You chose a point where price didn't really fall that much. Like, yes, you made money one week, lost it the next. Made money one week, lost it the next. And that kind of takes a little bit of patience and discipline. If you're a new investor in the markets and you see your balance just yo-yo like that, and even at this point go below your initial, there was plenty of opportunity there for fear to get the better of you and say, this doesn't work. I tried it for 4 weeks and I'm now down below my initial deposit. I'm going to take my money out and leave. And you would have been one of the 4 in 5 people that left the markets with less than you deposited with throughout that easy of a year. Like, price basically just went up, but that's only because we're looking on the weekly time frame. If I just highlight this box there, just like that, and we dive in on a deeper basis. Okay, let's go on a 4 hour. So this is more realistically the price action that you would have held through looking on the 4 hour time frame. So yeah, price went up, price went down, price went up, price went down. The amount of traders and investors, okay, that have a clean run like this and then they suffer a retracement, and the emotional impact of this wave there takes them out. And they're even up more than they deposited, but the psychological effect of losing their gains makes them fearful that, oh, well, what if I carry on losing even more? And they'll go through this wave, up and down, and then go, this doesn't work, it's too much risk, I don't want to lose the rest, pull their money out. And now they're out of the markets. When you could have had such an easy year if you just held. But people get into the markets without educating themselves about how they move. They move up, down, up, down, up, down, up, down. You know, we've been through this in the previous lesson about wins and losses. This is just how the markets move, okay? It's not going to be one straight line journey up. When you're winning, this is how it looks. When you have full transparency and full visibility on your balance, this is how it will move, and you have to be prepared to see it go up and down and up and down and up and down. You might make some money and then it retraces, and then you make more money and then it retraces, and then you make more money and it retraces. You need to be understanding of that is going to happen in the financial markets, and not let that retracement scare you into the point that you're thinking, this doesn't work, I'm going to pull my money out. Because it could all be so easy if you just had a winning mindset for the markets. Now then, looking at the same year, we're going to go into a dollar cost averaging approach instead, okay? And this isn't really a good example to try and showcase my point, but just to show you that I don't cherry pick stuff we're going to go through anyway, okay? So instead of just depositing there and leaving it all year, what we're actually going to do is deposit on the start of every single month. So this is going to be our first deposit, which was the start of January. Next up is going to be the start of February, and we're going to deposit about there. Then we're going to deposit at the start of March, about there, and then we're going to deposit at the start of April. Okay, so now each of these lines represents a deposit, and at the point that it intersects the graph is where your deposit would have been. So how dollar cost averaging looks is, instead of gambling and saying, I'm going to invest here, you're basically saying, I'm going to invest here, and here, and here, and here, and here. So instead of gambling at any one of these points, so picture this, like you could have picked there as the day that you want to start, and you're gambling that is going to be a good day. Instead, what you're actually doing is spreading it out over time. And yes, in this one example of 2021, it would have been better to just deposit at the start of the year and hold there. But how do you know that it was going to be a winning year? Okay, it could have been a losing year and you would have just gambled on that point. More so, it could have done this for the whole year, okay? And at that point, you would have made no money at all because price finished the way it started. Versus with this dollar cost averaging approach, you would have then deposited there and there and there and there, and basically filled out the whole thing over time. Your average deposit would have been somewhere like there, and in the same year, that amount would have been your gain, okay? Like that, because you've spread your risk out over time. Yes, in this example of 2021, it paid off to just deposit once at the start of the year, but that's kind of also an example of time in the markets. You're letting it play out over time. There were plenty of examples where you could have got scared and pulled your money out, where it actually came back to the same value at the start in those two instances, despite you leaving it to run for a couple months, you know. So dollar cost averaging, as I've shown you there, is definitely a smarter approach to trading the financial markets because it spreads your risk out over time and it's not gambling on this is a good time to invest. It's more just acknowledging that this is going up over time. So rather than gambling on a good time, you're using the power of time to your advantage. The next example that we're going to go through is 2020. So let's have a look at the year before, okay? We'll go here. So let's line up the start of the year. It's like that, and let's line up the end of the year like that. And if you would have bought at the start of the year, you would have bought around there. And if you would have held till the end of the year, you would have left about there. So as a buy and hold approach, you would have made about 17%, which was a pretty good year. However, look at the way price moved this year, okay? So you started off with a little gain and then you experienced a crash going all the way through there. You would have had to have some pretty good nerve to hold this if you were a novice investor, or if you were a smart investor, you'd understand this is actually a really good buying opportunity that prices fell this much. But regardless, if you just bought once at the start of the year and held it, you would have kept holding and you would have actually made money. Even though the market crashed, even with the market crashing, if you just held through it, it came back and you actually made money within the same calendar year. Nice and easy. However, for this example, we're going to take a look at if you actually dollar cost averaged this year. Instead of just picking one point to be like, now I'm going to invest at this time, if you dollar cost averaged and said, I'm going to put a fixed amount in every single month, let's take a look at how that looked in comparison. Okay, so now what I've done is I've lined up the start of the year, the end of the year, the low of the year, and the high of the year. Now what I'm going to do is plot the start of every single month so you can see with a dollar cost averaging approach, where would your buying points have been throughout the year. Okay, so now I've got those plotted. You can see that we would have bought here, price rose, dropped again. Would have bought here, price rose, and then dropped all the way down here for this month. So now price is there and we buy there. So now you'll start to see the benefits of dollar cost averaging. At this point, because you've saved a lump sum deposit here and chose to spread it out over time, now you're able to buy at better prices than if you would have just bought at the start, because compared to this point, these points are lower. So you're actually getting in at a better entry because you waited and spread it out over time. But like we said before, when prices at that point, right there, there is no way of telling that this is going to be a high or a low. So instead, you spread it out month by month. And no matter what happens, if price goes up, if price goes down, you know you're investing at regular intervals, and therefore you're catching a more balanced price over time, just like this. So no matter if the market's up, if the market's down, you're buying at each interval. And what that's doing is it's catching a more balanced price over time. And look what you're doing. If I connect up these deposits dot to dot, it basically emulates the actual equity curve of the thing that you're buying. So if we're acknowledging that what we're buying is going up over time, and you're catching the average price of it over time, this is what happens, okay? Your deposits just start to mirror the equity curve, rather than if you deposit at any given time, it would still do the same thing. So if you deposited there, it would still emulate that equity curve, but how do you know you're getting in at a good time? You could deposit at the very top, at a peak, and then your equity curve from then on is just down and back up again. But if you spread that over time, you're still emulating the equity curve, but by doing it this way, you're spreading the risk out over time and ensuring that you catch those troughs that come up in the future, average into them, and then catch them back for the long run. Now, here's a secondary benefit of dollar cost averaging, okay? Let's put yourselves in the shoes of this investor at the start of the year that put a lump sum in on the start of the year, on this day. They saw their price go up and then it went down. A little bit fearful. They saw price go up and it crashed all the way down there. Super fearful, okay? A move like this drives so many investors out of the market. Beginner investors, that is. It actually attracts a lot of smart investors to put their money in at these points. If you can buy at a crash, it's one of the biggest opportunities that you can get to buy in the financial markets, okay? So, if we're talking about dollar cost averaging, it actually makes crashes and troughs in the market quite attractive, because you know you've got a buy coming up at the start of next month. So it makes the losses a lot easier, because if you have a losing streak, if you have a winning streak, you know that you've got an opportunity to buy at a better price in your next entry, okay? So rather than you choose to deposit once and you just hope that it always goes up from here, you kind of appreciate the market coming back a little bit so that you can get in a better entry for a price to come up. Because if you buy here, then that individual position of, you buying there and holding it all the way up there is going to make so much more than if you bought there from there, okay? So for example, we said this position that if you bought there and held up to there made about 17-18%. This position here made about 50%. So when the market starts to fall and go down and you're buying it, a position from here or here or here or here is going to make more per trade than that one position from there to there. Okay, last example that we're going to look at is on gold, and we'll have a look at gold in 2023. In this specific year, the value of gold actually decreased. So if you were to just buy gold here at around January 2023 and held it for the year, you would have lost about 28% of your investment. And at that point, you wouldn't have actually seen it come back until about March 2020, okay? So this single lump sum investment was negative for over 7 years, okay? So if you just chose one point, if in January 2013 you said, you know what, I've got 100k, let me just buy some gold, you would have been down on your investment up until March 2020, okay? However, if you approach this as a smart investor and you said, I've got 100k, let me dollar cost average and put £1,000 into the markets every single month, okay? You would have kept buying all of this, okay? Regardless of if it went up or down. Yes, I know these aren't months, so I'm absolutely making a mess of this, but you kind of get the point, is that when price was going down, you're getting such a better price over time. And we talk about timing the highs and the lows, you can't do it. So the most accurate way to ensure that you're buying at the lows is to just keep buying and buy spaced out and buy over time, because then you're going to catch all the highs and all the lows, but you basically just riding the average price over time. So look at this guy, okay? He spread his £1,000 out every single month. Instead of saying I've got a lump sum to invest, he says, here's my cash flow, here's what I'm going to invest every month, here's my paycheck, I'm going to put 20% of that aside and invest part of that into this, part of that into that, whatever. £1,000 of that is going to go into gold, okay? With a dollar cost averaging approach, over the same 7 years, the person that deposited once has made zero. Okay, he's just lost out over time. The person that dollar cost averages got an average buying price probably somewhere around this line. Okay, maybe not, but let's just hypothetically say that line. Instead of making zero from this day to this day, even though price has changed by zero as like a net sum from there to there, because they spaced it out throughout that time and their average buying price was about there, they've actually managed to make about 22% return on their investment, even though price hasn't even increased. It's because they spaced it out and managed to catch better prices throughout the drawdown. And so while this person's position was just in drawdown and then it recovered, this guy was buying into the drawdown. And as the drawdown has recovered, that recovery became his gain. So to recap then, here are some benefits of dollar cost averaging. Number one is it removes the emotional effect of investing. It doesn't mean that you're timing the market and saying this is a good time to invest and I'm going to put a lot of stress on myself that this is the good time to invest. No, instead it says I'm going to remove emotion from my decision making and I'm going to spread my deposits out monthly, acknowledging that this might not be the best time, might not be the worst time. I'm going to do it anyway. And that is a structured approach to entering the financial markets, and one that is very sound and very respected amongst smart investors. Number two is that it spreads out the risk. Instead of gambling and saying today is a good time to invest, you're just saying this market is good to invest in, and you're spreading it out over time, and you're not risking depositing at the top of a mountain that then just falls and recovers in 7 years. Instead, you're spreading out your risk over time, and as long as price keeps rising steadily, you're going to make money over time. And you've seen the example, price could actually fall and just recover along a 7-year period, but by spreading out the risk over time, you've actually caught the bottoms of that market, and what would to some people just be recovering their drawdown actually becomes your gain because you've spread out your risk over time. Number three is that it ensures consistency. Consistency is a lot of people's problems in the market, and they always say, oh, I'm kind of good at investing, I'm kind of good at trading, I'm just not consistent. If you remove a lot of the emotional factors from trading and investing, and you just say, I'm going to invest on the start of every month, you're forcing yourself to be consistent. You're giving yourself an investing and a trading plan to say, all I have to do is deposit this same fixed amount at the start of every single month. That's my plan. It's so easy to be consistent because you remove the fact that, oh my God, this is a really good month, or you remove the fact that, oh my God, this is a really bad month, okay? You start to see that after a bad month, oh, that's actually a better entry point. And even when it's been a good month, you then say, oh, my deposits previously have now gained. But you kind of see the advantage of being in the markets over the long run. Even if it's a winning month, even if it's a losing month, there is a benefit in just being in the markets. Because when they move up over time like this, guess what? It's guaranteed to go up and down over time. So dollar cost averaging and spreading it out every single month is a way that you're using the power of time to your benefit. Number four is that it smooths your volatility. We've kind of touched on this already, but basically as the market is wildly moving up and down, you're catching a smooth, balanced average price of that over time, rather than gambling on this is going to be the low. Oh wait, no, this is going to be the low. Oh wait, no, this is going to be the low. All of that gets smoothed out and you get a much better way to trade the financial markets. And number five is that you feel much more comfortable when there's losses and losing streaks, because you know you've got another redeposit coming up next. Okay, so after the market's had a losing month, if you just deposited once, that's going to really hurt you psychologically. But when you're dollar cost averaging, you know, oh my God, this is a better entry for next month then, because the price is just going to go up again over time. Now I'm getting a better entry point. So like we've said about losing streaks and losing months being one of the hardest parts about investing and trading, dollar cost averaging is a way that you can actually flip that on its head and say, this is giving me a better entry point.